current economic fluctuations caused by the global political situation not only create problems, but also open up opportunities. How has this situation affected fintech, and which technologies should we turn to in order to tame uncertainty?
Well, of course, fintech has been affected by this complex downturn, and we see it in many different ways. First of all, we've already had massive layoffs in the fintech industry, some of them in the order of 10%, maybe even 25% in subsectors that are hard hit, like buy now, pay later. Overall, I would say that the sector, as an employer, the fintech sector probably is down 10%. I'm thinking of the numbers that the Center for Financial Technology and Entrepreneurship, CFTE, reported in a brilliant report last year. That number was around 300,000 employees globally in the fintech sector. Again, I would estimate that now we are down about 10%. The other factor and KPI that the fintech sector has been visibly sort of been hit is in terms of the capitalization, in terms of the valuations. If we just look at the publicly traded fintechs, they're down in the range of 50%, 60%, maybe even 70%. I mean, I'm talking about fintechs that have been successful, like Square, now named Block, or PayPal. So the market capitalization talks how painful this downturn has been. Even in the private sector, a lot of fintechs that need to go to capital markets, their valuations are also down. Again, the buy now, pay later sector has been hard hit, with the example of Klarna having to raise capital around, I think, 800 million recently, and their valuation was down 80%. That is 80. That is detrimental. Even Stripe, a very successful fintech that is still private and that hasn't needed to go to capital markets, they alone lowered their valuation by 30%. So we get the picture. Things are difficult in terms of market valuation. On the other hand, I think that what we're going to see here is deploying technology to serve the needs in this macroeconomic environment. And we're going to have an increasingly larger part of the population being financially fragile. So we will have to innovate to serve those needs. And I would say that we'll probably see more funding and more focus in subverticals that are more recession-proof, like lease to own, or maybe subscription type of models where they bundle services so that the end customer, be it retail or business, really pays for what they need. So that's really how I see this downturn. It's an opportunity to innovate because, as we all know, necessity is the mother of invention. And I foresee that artificial intelligence is going to be a technology really at the core of this phase of growth of fintech.
AI in financial services. Afi, where in financial services AI is currently implemented and for what purposes?
There's a very wide range of use cases, starting from the ones that are for consumer-facing purposes. I would say that the first use case was and is about chatbots at call centers, really leveraging natural language processing. And then the next level is for PFM, personal financial management, where AI sends notifications with budget tips, spending tips, notices about predicting cash flow shortages, overdraft fees, and so on. Then there's a big use case on onboarding customers, KYC, AML, being able to do that 24/7 and seamlessly. Advanced use cases for fraud detection and cybersecurity. And then the next big one is really in the lending space that we have diverse use cases of AI, compliance on all verticals, compliance in consumer banking, compliance in the wealth space, many AI cases there. And then I would say in the B2B, there are very interesting and more sophisticated AI use cases in research, in investment banking, and corporate finance and capital markets, trading algorithms, risk management in asset management is a case not new, but more use cases in supporting the role of chief financial officers, CFOs, their role and importance in the corporation has changed, and AI is helping. And of course, in insurance, credit claims, and so on, I think that's one of the other big AI use cases.
Credit is the fuel of any economy. So, could you tell us more about the different ways of using AI in lending?
Lending has mainly been used for credit risk. And I would say that the largest percentage of fintechs or bankers that are using AI in lending today are doing it at the origination level. So really assessing creditworthiness of new customers by using alternative data and gaining insights at the origination level. Fewer lenders are taking AI to the next level, which is about credit risk monitoring of existing portfolios, of existing customers, to see if their creditworthiness is changing, to notify them before they become delinquent by the predictive abilities of AI in terms of their cash flow management, and also in terms of collectibles. I would say those two use cases are a little behind, but they are growing. In terms of this second growing part, I would say that compassionate lending, as in helping customers repay their loans before they become delinquent and maybe restructuring by using AI and customizing repayments or proposals of how to not face these difficulties. That is a big area that AI will be used more again in this tough macroeconomic environment.
Afi, could you provide some practical examples of the successful AI implementation?
One of the most successful examples of using AI comes from the East, looking at my bank, which is part of the Ant Group. They have been providing millions of collateral-free loans to small businesses, and they have done that with AI 100%. It is the infamous 310 loans, which means it takes 3 minutes for the loan application, 1 second to approve or disapprove, and 0 human interference. I think really this is the best example of deploying AI at scale in the credit context. If we look at India, there's a great fintech called Zest Money, and they provide the tech stack to use AI and evaluate the credit worthiness of people with no credit. There are many in India with no credit history, and they use alternative data and AI to profile these customers and accordingly decide, credit limits and size that. Another great example in the personal financial management space is the chatbot of Bank of America, Erica. Erica is so successful and proved its success during the COVID crisis, but in 2023, it is predicted that Erica will save Bank of America 1 billion hours of human work hours.
Hard to imagine the number.
The number is really mind-boggling. And there's more such chat box coming from, for example, Bank of Montreal. They have what they call the Cash Track Insight, which notifies customers about cash flow problems in advance or price hikes in their subscriptions. So we see these personal financial management use cases. Fraud is a very big one. I would say that JP Morgan, that processes a huge amount of payments, consumer payments, they have implemented proprietary algorithms to really detect fraud at the consumer level, and especially with using credit card data to detect that fraud.
What about specific AI providers that enable the use cases in financial services?
Tech providers that come to mind, the first one when I think of AI is NVIDIA. NVIDIA is really very much focused in financial services on enabling explainable and trustworthy AI, which is extremely important in financial services because we don't want AI to be making decisions, for example, around credit worthiness in ways that are biased, in ways that are not explainable. Microsoft also is very much involved with their Azure cloud offering and in collaboration with, for example, Backbase and Finastra, and they have been working on several use cases in the mortgage servicing industry in the US using AI. In terms of chatbot AI and the use cases, some of them are already mentioned around, personal financial management. One of the successful names is Casisto, which is exclusively offering chatbot technology for financial services in this area. In, I would say, regulatory compliance, a huge, ever-increasing, ever-changing area. Think sanctions, think new regulations. Companies like Cube out of the UK are using AI and machine learning for this purpose. Comply Advantage is really specializing on financial crime. They are 100% AI driven. KYC and identification services, very important in financial services. Trulio is a name that comes to mind. I mean, the cases of AI in fintech is really very, very broad.
Obviously, fintech has helped to reduce the number of people who didn't have access to banking services, as well as those who are underserved. So most of the work has already been done, right? In other words, have the main problems of the financially excluded been solved?
I would say that there's been progress in terms of financial inclusion. The top number right now of people that do not have a bank account, I think according to the latest report from the World Bank, is 1.4 billion, down from 1.7 billion 3 years ago. But at the end of the day, we don't care about bank accounts. What we care about is whether people have ways to send money and pay their bills, whether they do it through a bank account or a fintech. It really doesn't matter. So fintechs have helped a lot on this front. They've also helped people that have low or no credit history to avoid or at least reduce their interaction with payday loans and build a credit history. But the problem is not solved. And the evidence I see is, look at how many offerings of early wage access we see in the market. Nearly all fintechs are offering in the US early wage access. And we see also banks starting to integrate early wage access. What this tells me is that there is a problem. We have a population in one of the most developed countries with an increasing part of the population living paycheck by paycheck. And this is going to get worse. And we're talking about people that are not unemployed. There are people that might be earning even 100,000 a year. So we need to provide more services to the underserved. That, unfortunately, is a growing problem rather than a shrinking problem. So to me, it seems that ideally we should be streaming money. Think of what Lyft and Uber are doing by giving their drivers their earnings on the spot. We should be able to do that. And we're not there. We still have also big parts of the populations, like, for example, in the Philippines, in Vietnam, in Mexico, that remain underbanked, meaning they cannot pay their bills and take hold of their earnings and manage their financial lives. We need to continue thinking around the necessity or not of a universal basic income for those that are in need. We need to think what financial inclusion means. What does it mean? Doesn't it mean that we are able to direct capital where it is needed? Do we need programmable money to do that effectively? Those are the questions that we need to ask ourselves in order to design and distribute flows where they are needed. So we have progressed all in all, but there's a lot of work to be done along the lines of financial inclusion of the underserved and feeling the needs where they are in real time, if possible.
Interest in asset management technologies, the so-called WealthTech, continues to grow. Why does WealthTech pose a threat and opportunity to conventional players in the asset and wealth management space? And what are the hottest trends in this area?
The reality is that WealthTech or Fintech has really commoditized a significant part of investing. Think robo-advisors and commission-free trading. They have contributed to the reduction of margins and the democratization of access to a large part of the population. Especially in the US, as I mentioned earlier, we see even subscription packages that have zero commission offerings, so no fees to invest, plus some advice, and there's a subscription for anybody. This was unthinkable 5 years ago. We are customizing and designing hybrid models around digital advice. We are at a stage where fractional investing, which is clearly democratizing access, is quite standard. We have WealthTech providers that are offering this, and it can be embedded anywhere. The WealthTech industry has transformed investing and wealth management in several ways. We have digital onboarding, now it's standard, automatic rebalancing of portfolios and access to low-cost investments. That's also standard, and that's been accomplished through WealthTech. The customer expectations have changed. So customers not only expect more transparency in the fees, because before there were a lot of hidden fees in the investment management sector, so that's a big change. They also expect access to investment opportunities, research, and tools that before were only available to high net worth or corporate clients. So we have the democratization of investing. What does this mean in practice? We are seeing, for example, private markets being accessed by retail investors, either through tokenization. This is very prevalent in Asia, tokenizing private equity funds that typically have minimums in the millions, and now they're tokenized, and accredited investors can build a diversified portfolio with minimums of let's say 10,000 or 20,000. The same with hedge funds. We are also seeing in Southeast Asia embedding wealth in the super apps, so wealth as a service, and this is at not the sophisticated level, but it really democratizes access to investment opportunities. In the US, which is a much more mature market, we are seeing the large incumbents offering powerful digital tools to their financial advisors so they can serve better their end clients. Morgan Stanley is a great example of this with their so-called next best action platform for financial advisors, where they have integrated a full suite of digital tools that is really powerful. In my opinion, they are the most advanced in integrating tools, sophisticated as much as including risk management tools at their fingertips from the BlackRock Aladdin system that they use. And let's be clear, a lot of big banks use BlackRock's Aladdin risk management system, but that doesn't mean that it's integrated with their wealth management business. So integration is a very big differentiating factor. Bank of America has its own integrated holistic offering that's called Life Plan, which is for customers to manage their financial lives in a more holistic way. This is an integrated WealthTech offering that is enabled through these technologies. I would also add that WealthTech technology is opening up a huge blue ocean, an opportunity to serve at scale the so-called Henrys. Henrys are the high earners not yet rich that could not be served by the wealth sector. Here we have the opportunity to profitably serve them with service that was only possible within the private banking sector and the high net worth individual. Actually, Oliver Wyman sizes this opportunity of serving WealthTech, serving the Henrys, as big as $230 billion. So WealthTech is a huge opportunity opening up to serve at scale parts of the population that we were not able to serve them. I would add also that the relationship between asset managers and wealth managers is shyly changing, and this will unlock a lot of value. If asset managers are data enabled and connect with data enabled wealth managers, then really they can co-create not only personalized investment products, but really experiences for their clients that are personalized towards their financial outcomes and goals. And that is really where the gold is. Data-enabled asset managers and data-enabled wealth managers within an ecosystem.
I have one last topic, which is blockchain and tokenization. Afi, Bitcoin was first recognized as an official currency in El Salvador, and the Central African Republic joined on April 25th. Will this trend become global?
Clearly not, especially in this bear market across all assets. I think the realization that of the value rather of a lender of last resort is important in these markets, in the cryptocurrency markets. However, a Bitcoin could become part of the holdings of a central bank, much like central banks hold commodities or stocks as part of their reserves. And the reason I say this is because of the, I would say, monumental or one of a kind freezing that happened this year to the holdings of the Central Bank of Russia at the US Federal Reserve. This for sure has reminded all central banks of the importance of self-sovereignty. It's become clear that holding assets, holding reserves in your own sovereignty can be an important factor to consider. Look, the cryptocurrency market, as you mentioned, is a market that grew up from retail, but the last 2 years, I would say, there's been considerable interest from institutions and traditional players, even in DeFi, decentralized finance, last year.
The cryptocurrency markets have traditionally been dominated by retail. Institutional interest from traditional players has started to become significant since last year, even in DeFi. So what is happening now, and what do you foresee in the future, since 2022 has wiped out over $1 trillion of the total market capitalization of cryptocurrencies?
Look, institutional interest in cryptocurrencies and digital assets, broadly speaking, I would say remains quite solid, even in this bear market. Honestly, there hasn't been a week that goes by that I don't read quite important news that are around a product that's being launched by institutional investors, or a plan to launch or to partner with a crypto native player. When I look at the space, I think, of Fidelity first. That was an early player, serious player, participant committing with their digital asset division back in, I think it was 2018. And they continue to develop their expertise and their offering. It's not only custody, it's not only investment products, it also includes a professional trading platform. Recently, BlackRock launched a private fund focused on Bitcoin. A lot of headlines around that. The CME continues to roll out futures offerings, different underlyings, different dates, and so on. I would say that the custody business is a very significant subvertical of cryptocurrencies in which institutionals have been interested and continue to be interested. And there are two choices. Some have built their own capabilities. Nomura's Komainu, if I say the Japanese term, platform is very well known in-house built custody offering. Standard Charter also offers, I think the name is Zodia, They are built-in custody platforms, but many players are partnering with crypto natives and offering custody from Citibank that is going to work with Metaco. State Street is already working on an offering. I don't recall. I think it's with Circle. Yeah, the custody is with Circle.
Afi, what are your thoughts on tokenization? Following UBS example, how soon we will see banks start tokenizing their clients' assets?
I mean, personally, I'm very excited about tokenization. I was pretty impressed with one of the latest news of KKR, the big private equity fund, tokenizing a part of one of their funds on a public blockchain. A new partners group had already tokenized one of their private equity funds in collaboration with a Singapore Fintech in the business. I think those two moves are pretty important, democratizing private markets through tokenization. These are huge markets that have already been proven and accessible only to limited investors, and now they're being tokenized. I must mention the Swiss exchange, the Swiss digital exchange, which is the first regulated digital exchange that is already operating and offering the technology to launch tokenized equity and debt instruments, very important. And then in more of a pilot phase and running parallel to their existing business, DTCC in the US, the clearing and settlement entity, is already working on the so-called Project ION, that is about settling and clearing equities at nearly real time. I'm a little cautious on what happens with that and how soon it will be launched, because we are all aware of the fact that Australia, the ACX exchange that was supposed to be a huge success and was an early player in the space of tokenizing equities. They had the advantage of owning their settlement system, chess, but they have failed to deliver. They've been working with digital assets and nothing has happened. To date, I would say that it's happening. We need time to make this really work because we need the network effects. We need to build infrastructure not only for the origination of the tokens, to tokenize something, equity, debt is fine. You need the infrastructure for the life cycle management of those, assets, the digital assets. There's a lot of work being done in the US and the infrastructure modules being put together. We have to be patient and keep in mind that we want to use this infrastructure really to unlock value at the infrastructure layer, always for the underserved. Underserved has a broad scope. It's underserved with respect to paying their bills, but it's also underserved with respect to managing their investments, access to capital, anything that is a goal in their financial life, be it an individual, be it a corporation. Changing the infrastructure to facilitate these goals, these outcomes at scale is really what fintech should be about and should always focus on that mission.
Afi, what books could you recommend to our viewers and listeners, and what do you keep at your bedside table?
I am a big fan of physical books, although I do have my Kindle. I've had it for a long time and I love it, especially in the summer where I go back home and spend, I think, 2 months and work out of there, and then I don't have to carry books or I can download the book and so on. But I love physical books. That's one. So I usually have a stack of 2 or 3 books that I'm reading, and they're a mixture. Some of them are pure finance. Some of them are more futuristic tech. And the third category is what I would call more around my personal introspection and self-awareness. So, right now I just finished reading Brett King's book, which is a one.
Technosocialism?
Yeah, technosocialism. So, put it in the category. It's kind of in between, right? I would say tech and futurism and so on. And I've read Paolo Cironi's recently. It was my last Fintech book. I'm looking forward to reading a book which is around how digital twins will change the financial industry, and that's a book from John Blick, who is in the financial services, multiple times author in working in Australia. And then on the self-awareness side, I'm reading the book The Path of Integrity by Martha Beck, which is really about integrity is about being true to yourself and what that means. And I'm also listening to an audio book by Shiraz Shamad, if I'm saying his name correctly, called Positive Intelligence, which is about how to manage our emotional intelligence and identify our saboteurs in our personal and work life. And really, to me, this is what does empathy mean and how to really use it in life. So I need this mix. And I must also confess to you that I'm an author myself, not only of finance books, especially when I was on Wall Street. I collaborated 2 times with Frank Fabozzi. We wrote books on emerging markets and so on, and I contribute to books now in fintech and finance quite frequently. But I'm also an author of a fiction book. Unfortunately, it's in Greek, and it's all about cynical, satirical view of life on Wall Street. And I always like to be a little cynical, satirical, because I think that's the best way to deal with our lives and self-reflect.